All right, welcome back to another episode of the Black Bullion Show. Silver, silver, silver. What can you say about it right now? Well, these past few weeks have been amazing for us silver bugs, and we've already ran past $28, and $29 is definitely in our sights right now. And who knows, we may even hit it before this video even comes out. Now, we had the jobless numbers come out today, and they've begun to edge down, which is, good for those who no longer have to search for search for jobs. They have one. But this threw silver off for a couple of minutes, but it started to get right back onto its rally soon after, so it didn't hurt its path too much. But in this video, I'm going to show you why precious metals will continue to get a bid, and what other metrics we could be watching out for regarding economic contraction. But first, if you're new to this channel, please hit that big red subscribe button right down below. Also, please hit the like button. Helps to get this economic evangelism out there to the masses to bring more people into precious metals. All right, so let's hop right into it. So here we have one of the doing some inspection on this website. Here we have one of the crystal balls in the bond market, and it is the US 10-year yield, the real yield, mind you, when you factor in inflation. Yesterday, I showed you that we were roughly at negative 102. Now, as far as Tuesday, August 4th, 2020, we're at negative 105 right now. And, you got to ask yourself, where are bankers going to go if they can't get any real yield from the 10-year right now? Well, that's where things like silver and gold come in. Now, here we have this article entitled, "Gold Just Hit a Fresh Record High, but Some Say Silver is Set to Overtake." Now, this article points to a variety of reasons as to why silver will rise in dollar denomination. But here's one we've kind of alluded to here and there, but it gets very specific: the Biden effect. So let's get into it. The U.S. elections could also come into play, Citi said. Analysts at the bank said markets are pricing in the potential for more demand for silver if Joe Biden wins the U.S. presidential elections and delivers his green infrastructure plan. Under Biden's plan, commuter trains, buses, and passenger vehicles will run on electricity or clean fuel, and clean light rail and bus systems will be developed. In addition, the plan includes offering incentives to upgrade housing and commercial buildings to make them more resistant to extreme weather. During bull markets for both metals, fleet often ascends faster than its heavier, more expensive cousin. Ned Leyland, precious metals fund manager at Jupiter Asset Management, wrote in a note last week. He pointed to the use of silver in an increasing number of medical applications, as well as in electronic components for 5G telecommunication networks. Now, apparently, Citibank says analysts or the markets are now starting to price in, Biden's green infrastructure plan if he wins. But that's pretty interesting, given that by default, you would have to assume that there's a chance of, a Biden victory. But in addition to that, silver will also be supported by further economic contraction, such as this: auto loan delinquencies. Now, you may be surprised to hear this, but behind student loans and mortgages, auto loans are in third place for debt held by individuals in America. Check out some of these graphs here down below. So for the first one, we have the number of car loan accounts in the US, and it has skyrocketed Pretty much the highest number we've been at, going as far back as 2003. We've just ballooned up after 2012. Check out this other one. Car loan percentage of total US debt balance. So that's gone up from where it started to bottom out around 2010. Now check this one out. Car loan originations by credit score. So as you can see here, 760 and up is the highest one. No surprise there. But take a look at this red line here. This red line here represents the lowest bracket, which is below 620. And from time to time, going back to 2006, it was number one to 30%. Dipped back down to number 3, went up to number 2, and went back down to number 3. But it looks like it may be trending up, while the current number 2, 660 to 719, starts to trend down. So that's pretty worrisome if you are concerned about delinquencies, especially in a time right now. And then also you have car loans, 90 plus days delinquent, and that has gone up, kind of matching the delinquency rate that we saw in 2010. We've already gone past the delinquency rate that we saw in 2009. So we're approaching that point right now. We're at 4.94% in 2019. It was 4.99% in 2010. So we're basically right there. Now, with delinquencies trending up, along with the amount of loans increasing, along with those with a credit score below 620 being third highest in auto loan origination, things like this may be something to watch out for. Now, here's some additional information on this by the Motley Fool. Auto loan delinquencies are a house of cards. A third economic indicator that suggests the stock market is in big trouble is auto loan delinquencies. What you're probably thinking is that I'm going to harp on rising loan delinquencies tied to the Ronies, and you're partially correct. The real issue, though, is that auto loan delinquencies have been rising since 2012 and long before the Ronies turned our world upside down. According to data supplied by the New York Federal Reserve, auto loan delinquencies that were at least 90 days hit an all-time high during the fourth quarter of 2018, at least based on the New York Fed's 19 years of record keeping. Meanwhile, the American Bankers Association pegged auto loan delinquencies at an 8-year high as of the third quarter of 2019. Your preferred source may vary a bit, but the data all tells the same story. Car owners aren't paying their bills on time, if at all. To be clear, the auto loan market is nowhere near the same size as the mortgage origination market that crippled the financial sector in 2008 to 2009. Then again, it's not a negligible amount either. Based on data from Federal Reserve Board of Governors, there's nearly $1.19 trillion in outstanding motor vehicle loans as of Q1 of 2020. If we see something like 1 in 10 of these loans default for an extended period of time, that's going to put a hurting on a money center and regional banks that originated these loans. So that would be one problem that banks don't need, as the fear of mortgage payments is likely a stressor for many of them right now. And this is a metric to keep an eye on for continued economic contraction. So now let's see where silver is right now, and also let's see where gold is right now. So it's pretty much up and away, and it's no different today. I still honestly can't believe that we're past $28 per ounce for silver, and gold was basically around 2070 earlier today, starting to trend down a bit. Same thing for silver, but gold is definitely trending down a little bit more to 2052. We're at $20.06 for silver right now. But honestly, I wouldn't be surprised if we hit $29 soon, either, tomorrow, or could be the day after. Who knows? It could even be today. So things are looking pretty good as far as momentum for both gold and silver. So guys, that was your Thursday. Let me know what you think about these auto loans being something to watch out for, and where you guys think silver will go today. Do you think it'll hit 29 or maybe the mid 28s? Let me know in the comment section below. All right, thanks again. Please hit that like button, and please hit the subscribe button if you're new. We have 2 more episodes coming out today, one an hour from now and one 2 hours from now. All right, thanks again. It's Black Bullion.